right, we are back with another episode of the Real Estate Investing Club. Today we have Michael Coffey with us from Stack Source. This is going to be an interesting episode because we don't often talk about the debt side, about loans, especially when it comes to commercial real estate. And Michael is an expert in commercial lending, so I'm super excited to talk about this. I'm actually, Michael, I didn't tell you before we got on here. This is the first time I'm in the process of buying a $3 million property. It's the first time I'll have a commercial loan. Up to this point, I've done all seller financing, so I got a lot of questions for you, which is perfectly
Ooh,
timed.
that's
I'm
great.
super excited to jump into this.
Perfect.
So yeah, Michael, thank you for hopping on the show.
Thanks for having me. I appreciate it.
Absolutely. I told you before we got on here, we like to start with stories. We like to hear how people got to where they are today. Sure, you got a good one. So why don't you take us back to the beginning? How'd you get started in real estate?
Yeah, I think like most people, I just kind of happened into it. I started off actually in the residential lending world, and this was back in 2000, in the early 2000s, and just couldn't swing it as a loan officer. The sales game was not something I was interested in learning. I love the nuts and bolts aspect of the business, but being a salesperson did not appeal to me at all. So I ended up joining with a firm that had a residential and a commercial lending division,
Mm.
and was there for 20 years, 20 plus years. And in that time, ended up working my way over into the commercial world. Really, really love the numbers part of commercial real estate. Being involved in deals where people weren't interested or cared about the color of the way it was painted or decorate. It was just about the numbers, and it just really appealed to me. And then worked in the back office there, putting files together, coordinating the loans for the originators, documenting files, working with underwriters, appraisers, title folks, really learning all about the business, all the different aspects of it. And one day was shaken and told, hey, you can do the sales side. This so well. This would be a good convergence of skills. And so I took that on and said, okay, fine, I'm ready to learn something new. And so I have since, leveraged all that, almost 2 decades of learning, and I now apply it to originating commercial debt and equity deals.
Nice. I love it. And that the way the you didn't put the cart before the horse there, because you got the experience, you got the knowledge, you got the wisdom, getting all the numbers, understanding the underwriting, and then you got into sales. I feel like that generally works better because then you understand the product better, you can sell it better. So it makes a lot of sense. Sounds like you did it the right way. And underwriting is one of the hardest parts about real estate. If you get it wrong, you're in for a rough ride. But if you get it right, then you can breathe a little easier because you know that your deal is not going to, or at least there's great potential in the deal that you're doing. So let's start there in the underwriting portion. From a commercial lending perspective, working with the banks, what is it that the banks are going to be looking for when they look at a commercial, underwriting a commercial deal?
Well, obviously debt cover is the most important item that we look at. How you get to that NOI to figure out what your debt cover is, I think is part of the fun part of the journey when I'm analyzing a deal. The way I do it and the way I present it to a potential capital source is I just use the current rent roll. I don't necessarily look at historical income. There's a lot of stuff that can happen that can impact that number, the way they keep records. If they're counting deposits as income, that's false income, right? Or if they get large prepaid rents in one year and it doesn't filter over into the next year, the P&L looks screwy. So I take the current rent roll, that's my income, my gross income. I apply a realistic vacancy factor. Then I start tearing into the to the expenses. And those are, if I'm looking at an acquisition and I have a flyer from a listing agent, I'll take the taxes, I'll take the insurance, the utility number. Then, because I work closely with a lot of appraisers, I do have a good idea of what numbers are going to show up in the appraisal for some of those, shall we say, squishier numbers like repair and maintenance, turnover, landscaping, all those things. I'll work with the buyer to figure out, what's your plan for landscaping? Like, are you going to hire someone out? Is your manager going to take care of it? Like, how are you going to tackle this? And I try and present it that way to the lender so that I'm not using pie in the sky. I'm going to use a management fee, even if it's a smaller property. And I know this guy who owns, 40, 50 units, he's going to manage it himself. I'm still going to underwrite in a management fee because that's what a lender is going to do, so that we get to a realistic number. Because what I don't want to do is overpromise and deliver this NOI that's just completely not going to hold up under scrutiny. So we try and get real with that number.
Yep.
So that's how I do it. But the banks, yes, they're going to focus in on that NOI very tightly, and everything is driven off of that.
Yep, that makes sense. And it makes a lot of sense. I mean, you start with the current rent roll versus the the previous year's P&L, NOI. And so that makes sense to me, because you're right. The P&L can just be all over the place, especially if you're dealing with a property that was recently purchased and they did a lot of work in the last year. Maybe they increased vacancy from 20% to occupancy from 20% to 90%, or that's a
Yeah.
huge jump, but you get the idea. They can definitely fluctuate. So looking at the current rent roll makes a lot of sense to me. When you're talking about debt coverage ratio, what is the debt coverage that you're generally looking for a healthy loan?
Yeah. So it's going to vary depending on the asset you're looking at. But if we're talking multifamily, which is obviously the most common item out there, the most common asset class out there, there's still a lot of lenders that will underwrite to a 1.2 debt cover.
Okay.
There are some that are starting to drift to the 1.25, just to try and account for some, market fluctions that may or may not happen in the next year, just to be safe. But 1.2 is still obtainable, yeah. And then as you get into retail and office, you're really pushing that to 1.35 at best.
Yep.
Is what I'm seeing.
And for those of you who don't know, debt coverage ratio, a 1.25 basically means that your NOI is 125% of your debt coverage, of the debt that you're paying every month of your mortgage. So if you have a mortgage of $1,000 every month, then the bank is looking for you to have an NOI of at least $1,250 every month.
Yeah, they want you to make a profit. So that's the difference. There is your profit margin. Yeah.
Which makes sense. I mean, you don't want to buy a losing business, which is actually a question that I'm going to get to in a second. But before I do that, you already talked about asset types. I know that, assets vary widely. You can have a hotel, hotels, they run at their income can generally fluctuate much more than something like a multifamily. So when it comes to asset types, was there a specific type of asset that you like to underwrite more, that banks are more comfortable with? You already mentioned that, retail will go at 1.35 for debt service or debt coverage. Give us a little detail on the specific asset classes themselves.
Yeah. So, multifamily will always be the preferred asset type for most debt providers. It's the most in demand, and generally that is generally true. So they're going to get the most aggressive on that asset type, both with their underwriting and with terms. Retail is, at this moment in time, I think it's a little bit in flux as far as how desirable that is from a bank perspective. That said, there's a lot of capital providers that is their specialty,
Hmm.
so they feel way more comfortable underwriting that asset type. Again, they're gonna be looking at a 135 debt cover. But they will, and this has been a great change the last 5 years or so, is we're seeing a lot more institutions go with a 30-year amortization
Hmm.
on that asset class, which before then was unheard of.
Yeah.
Now, when we get back east and some of the Midwest states, they still favor the 25-year amortization, some of them even 20. But we do have, through StackSource, we have a lot of national providers that will do the 30-year regardless of location.
Yep.
Um,
And the longer the amortization schedule, the more favorable it is to the GP, to the sponsor of the project, because that means you have less money that you're paying out every single month. Although you are paying more in interest, um, you still don't have to. There's a little bit more wiggle room when it comes to cash flow. So we love to see that. How about self storage? That's my specific specialty. Do you have any insight in underwriting self storage?
I love self-storage.
All right.
They're such cash cows. The NOIs are always so strong. Um, it's an interesting asset type because I think it's just recently kind of come into vogue with a lot of capital providers. Before, it was kind of this fringe, kind of like mobile home parks
Hmm.
to the multifamily world. Self-storage is to the industrial or retail world. So I love it. I'm seeing it show up in uh acceptable property types for a lot of conventional lenders now, and again, before it wasn't. I think what changed was when the SBA declared that it was
Yeah.
could be an owner user. I think that's when a lot of other institutions went, oh, okay, let's start looking at this. Now we got to compete with the SBA in this world, because you really can run that both ways. Um, so it to me, it's very interesting. But yeah, they can get aggressive. I mean, I've seen some at a 125 debt cover with 30-year am
Oh wow.
on it. I think the struggle with those assets, especially on an acquisition, is the vacancy. And I
Hmm.
think that throws a lot of banks off, because they can be so poorly run
Mm-hmm.
that when you're acquiring a distressed asset like that, it is scary for them to say, well, how are you going to turn this around?
Yeah.
And there's so much you can do with it. You can change the dynamic of the size of the units to make it more marketable. But yeah, I've seen a lot of those get turned around pretty quick by
Yeah.
by applying just a little bit of elbow grease to it.
Yeah. Yeah. This deal that I'm working on right now, it is, it's a bigger property, but still they don't have a website. They don't do
Yeah,
any marketing whatsoever. They have
so
one street
crazy.
sign on the highway, and that's the only way that they fill up. They're at 70% occupancy, which is still, it's respectable. It's not where, stabilization rate should be. It should be up in the 90s. But still, that's a very easy path to value add. And it's good to hear that banks are, amenable to seeing that strategy when it comes to lending. So the last question I had, we do have to move on, but I do have one more question about there's a word for this, but basically uh, assets that are value add. They're super fixer uppers. They have very low occupancy, and so they will not debt cover. They will not cover the debt. What is it? Investors out there who are looking at these properties, they know there's a lot of potential in the property. What are their options when it comes to acquiring this property, fixing it up, and then getting the debt for it?
Sure, yeah. There are two main avenues that I would look if approached with a situation like that. Because yeah, you're not going to qualify for conventional debt. So we can either look at a construction loan with a bank, right? Their expectation is most likely that they're going to retain the long-term debt. So that may or may not be in your best long-term interests. it'll get the work done, and they can build the loan around the future debt service ratio. They can build the loan around the future value and that sort of thing, which is great. There's money there to get the work done. You've got a good runway, 12-18 months to get it done. But you're going to be locked in with their debt at the end, and that again may not be the best option for you. So the another method is to go with a specific bridge lender. They'll do 12-18 months. Again, money's there. They'll get sometimes more aggressive on loan to cost, loan to value. But they don't want any piece of your long-term debt. So they want to get in, get their money, and get out. Rates are a little bit higher, but you are then free at the end of that construction period to either offload the property and have no prepayment penalty, or go chase down the best possible debt you can have. And the reason I like that better than going with a formal construction loan is you may get partway through that project and your exit strategy completely changes as the market shifts, or you start seeing, hey, we're not quite getting the rents we wanted. This is going to make more sense to sell when it's stable than hold long term. Or I don't want to hold it for 10 years. I may only want to hold it for 3. That's going to set up what kind of debt we put in place once you're ready. So I like the flexibility of that. Yes, you're paying a little bit of a premium for that in the rate, but a lot of times if there's room, we can build in an interest reserve to that. So it's not out of pocket per se. So that's how I would approach those. And it really, again, comes down to the underwriting and seeing what's a realistic stabilized NOI look like, and what can we really get for debt at the end.
I love it. All right. Well, hey, that does wrap up the first section. We have gone through our time, so it's time to jump into the quick question round. Are you ready?
I am.
Let's do it. Starts with books. I'm a big bookie, so give me 2 recommendations, one for general life wisdom, one for real estate specific.
Oh, let's see here. For general wisdom, I would say The Compound Effect by Darren Hardy. For real estate related, boy, that's a tough one, because most of what I read are sales books. So
yeah, okay.
There's a couple. If you're not familiar with the debt markets, there's a book called Commercial Mortgages 101 that really strips it down to its basic core. I think it's a good, helpful guide.
Perfect. Commercial Mortgages 101. That's sounds like something I should pick up. All right, that moves us to the next question. This is for your younger self. So let's go back to the Michael who is just getting started in real estate, just underwriting that first residential loan. Go to him, look him in the eye, give him one piece of advice moving forward.
Pick up a sales book.
There you go. Easy peasy.
Yeah.
Pick up a sales book. Sales, even if you don't like sales and if you don't think that your job includes sales, we all are salespeople. We are all it's our job in whatever job you have to have influence. You do have to sell, sell your position.
You're constantly selling yourself or your abilities to those around you, whether they be friends or your family. There's so much EQ wrapped up into the sales process that it has spurned so much growth. Even if I wasn't quote unquote a salesperson, there is so much value in what I learned through that process.
There you go. All right, that moves us to the next question. This is for your strengths. We all have unique strengths that we give to this world. What is your Superman strength?
I think it's the history that I discussed earlier, and in the way I approach what I do. It is so much more well-rounded than I think a lot of debt brokers end up being. They start off more as a salesperson and then kind of learn the nuts and bolts as they go, whereas I'm coming at it more as an analyst rather than trying to win a deal. I'm more interested in okay, what's this deal look like? How does it put together? And then how can I serve this investor now that we know this? How can we best serve them? So I think it's being well-rounded.
Yep. Having that base of underwriting, I'm sure serves you very well in your sales skill, which you just mentioned earlier.
Yeah.
And that moves us to mentors. None of us are islands. None of us are islands. None of us. Yeah, no, that's right. None of us are islands. We all stand on the shoulders of giants. I forgot my own phrase. Give me one mentor who has contributed significantly to your career today.
So are you saying Paul Simon was incorrect?
Yeah, I guess so.
I guess. Wow, that's bold. Um, I mentioned his book earlier. Darren Hardy is an icon to me in mentoring, productivity and efficiency, EQ, those sorts of things. I mentioned I was at a small kind of a boutique debt provider. The owner of that firm was the one that took me by the shoulders and said, "You can do this." So I would say, him in particular. Yeah.
Perfect. All right. Well, thank you for helping Michael to get to where he is. And that moves us to the very last question. This is for the listeners. You've given us a lot to think about. I'm sure people want to reach out who have questions about the debt market, about getting a loan for their commercial property. What is the best way for them to reach out to you?
Email and phone are both equally accessible. Phone number, I'm here in Oregon. It's 503-866-8817. That's my cell number. Email is michael.coffee@stacksource.com.
Perfect. I will put that email in the show notes. So if you guys want to reach out to Michael, go ahead and click a little more in the description, pull down the full description, and in there you can find his email address. Right on, Michael. That wraps it up. Again, thank you very much for hopping on the show.
Thank you for having me. I really appreciate it.
Absolutely. For everybody who's here with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions whatsoever, reach out to me, Gabe at therealestateinvestingclub.com. If you want to support the show, all that we ask is that you give us a little review, thumbs up, wherever it is, YouTube, Apple, blah, blah, blah. That's the only thing we ask. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode. Thank you for joining us for another episode of the Real Estate Investing Club. I hope you guys enjoyed the episode as much as I enjoyed putting it on, and we're able to pull some actionable advice that you can apply in your own investing today in the field. Before you go, we have a gift for you. If you're a new investor looking to get started or an established investor looking to take your investing to the next level, I've created an ebook just for you, available on our website. This ebook will cover how I was able to create both active and passive income in real estate with very little money to start with. In it, I will address the 3 most often cited obstacles new and veteran investors run into by showing you how to find deals that are actually deals, how to finance a deal with little to no money down, and how to exit those deals for maximum value. And if you get the ebook today, I am throwing in a bundle of bonuses, 7 of them to be exact. The first one will be the off-market lead generation blueprint, which will take you through the exact systems and processes we use to generate off-market leads like clockwork, which is the most important skill when it comes to creating wealth in real estate. The second bonus is the A to Z REI systems and vendors guide, which will allow you to peek under the hood of our business and see the exact tools, systems, and even the vendors we use to see the success that we do. And the third bonus is the top 100 best performing keywords pack, which will give you the exact keywords we use to target motivated sellers online using PPC ads. The fourth bonus is our contracts bundle for wholesaling and renting real estate, which will give you access to all the contracts we use in the field to execute all different types of transactions. After that is the Investors Quick Analysis Calculator and Offer Tool, which will allow you to quickly calculate whether a deal is an actual deal and will allow you to create an offer automatically from those calculations. This is a lot of bonuses that I said. I'm just going to keep going down the list. Number 6 is the Investor's Daily Success Tracker, which is a tracker you can use to ensure you are taking the right actions day in and day out to reach your financial goals in real estate. And the last bonus is the Wholesaler's Template for quick assignment cash, which will give you the templates we use to present our wholesale deals professionally and efficiently to our buyers. Whew, that is a bundle. So it's a mouthful. You get all of those bonuses for free when you download the ebook. All we charge is the admin cost to run the show. So if you're interested in the ebook and the bonus bundle, head on over to the website at therealestateinvestingclub.com. Click on Get the Ebook Bundle at the top of the page to take advantage of that deal. And with that said, I hope you have a fantastic day, an even better week. Keep rocking real estate, and I look forward to seeing you on the next episode.